I have started the recording of further. So let me see that whether I have, yeah. So, you were asking me, Mohit, something?
No, sir, no, sir.
Huh,
I was asking about this software only.
software now. This software is, around, I think, 20,000 rupees. And,
Sir,
but,
19, sir, 19.
huh?
19,787.
Like this, close to about 20,000. So, because otherwise you have a record option here also. I've never tried this. If you are looking at the presentation, at my presentation, there's a record option here. So you can even record. I believe there are some software which now come along with their Microsoft this thing. So you can even record using, your this thing. So okay, we'll try that later on. So let's
Yes, sir.
start that. Okay. Okay.
Sir, your screen is it's very small. Like
I know. I'm also seeing that. Why it's happening like this? Acha, because I have pressed this recording option, na, so that's why I'll just I have to restart this. Okay.
no, no, sir. You have to click slideshow mode. You just clicked on the recording mode, I guess, in the
That's why.
PPT.
So that's why I'm opening again.
Okay.
Okay. Fine. So this is basically, we were saying that, we have done all this. Okay, fine. So the recording is on now. Whatever we say, it will get recorded, and I'll share the file with you. So this is the whole process. The process is, first of all, the company, incurs some transactions. So the transactions are always there when you're doing business, and those transactions are basically recorded in journal entry, and then they are posted to journal ledger. So that becomes the main book of account. So whenever you want to, whenever as an auditor or as an accountant, whenever we go to a company, we ask for a journal ledger, because that will give you, accounts of each and every account which the company has, whether they are, capital account, whether they are suppliers account or debtors account, expense account, or income account. So as a lawyer also, sometimes you have to go through the ledger to understand, what all entries the company has passed. So ledgers are to be maintained by the company, and all companies are required to maintain their books of account, including vouchers, journals, everything, for at least about 8 to 10 years, and they can be used for as an evidence in the court of law as well as in your, tax assessments. So then, after you have prepared a journal ledger, you make a trial balance. Okay, so it is made on a piece of paper or on an Excel sheet, and then you pass certain entries to, basically it's a fine tuning of your, accounts. Once you have done that, then you make your financial statements. That is the, the profit loss account, balance sheet. Basically, that tells you, how the company has performed. So that's a very important statement. So we'll look into that. And then finally, you close your books of accounts, so that in the next year you can start afresh for passing these transactions. So we'll understand how the closing is done a little later. Okay. So Mohit, can you read, or Mihika, can you read?
Yes, sir. Financial transactions start the process. If there are no financial transactions, there's nothing to keep track of. Transactions may include a debt payoff, purchases or acquisitions of assets, sales revenue, or any expenses incurred.
Okay, now the transactions can be of anything. They can be, you're paying your debt, either the loan or any liability, or you are buying goods, purchases, because then you're going to sell those goods after processing them. If it's a manufacturing company, then you convert the raw material into finished goods and sell it. But if you're a trader, then you buy goods and then, basically in bulk and sell them in retail. And then you acquire some assets, for doing business. It can be for a manufacturing companies, it can be plant and machinery, building, factory. For trader, you can buy, computers, or, the furniture, or an office, or a retail outlet. Fine. Or then the sales revenue. So whatever, sales you do, they are recorded as transaction in the books of account, so that anytime you want to know what is the company's, sales revenue, so we can, look at the total revenue of the company, and then the expenses which the company incur. So all these transactions are basically, generalized, and the whole process is observed. Then, we pass journal entries, and we have already seen that. Okay, can you read, Megha?
Yes, sir. With the transaction set in place, the next step is to record these entries in the company's journal in a chronological order. Debiting one or more accounts and crediting one or more accounts, the debits and credits must always balance.
So we know that, after passing all the journal entries, and journal entries will always have a dual aspect, which means that one account is debited, another account is credited. So this has to be ensured. Then you post them to the journal ledger. Read it.
Posting to the general ledger. The journal entries are then posted in the general ledger where a summary of all the transactions to individual accounts
can be seen. Okay, so we have seen that in a journal ledger, we can understand, in a much better fashion that, how much money, assets we have bought. It will have individual assets accounts. It will have the capital account, how much the company's owner has, given money to the company, how much he has taken out. Okay, what is the profit the company has earned? So all will go to his capital account, and then finally, basically, your sales, your expenses, and your customers account, your suppliers account, all will have, have a ledger account for them. So it will be all there in the journal ledger. Then finally, you make a trial balance. Just read it.
trial balance. At the end of the accounting period, this may be quarterly, monthly, or yearly depending on the company. A total balance is calculated for the accounts.
So basically, you can draw a trial balance at any given point of time. Normally, a company makes a monthly trial balance because, on a monthly basis, company discusses about, how the company has performed in terms of what profits they have made, how much cash they have. So you make a trial balance and then they make the statements out of it, basically the cash flow statement, the profit loss and balance sheet, to understand, how the company is doing. So this can be either a quarterly or a monthly or yearly, depending on the need of the company. Okay. Okay.
Adjusting entries. At the end of the company's accounting period, adjusting entries must be posted to account for accruals and deferrals.
Basically, what is these adjusting entries? Now, whenever you are doing business, after you have made, all the transactions, there would be some transactions which may still not have been passed in the books of accounts because of, certain reasons. For example, like suppose you are running a business and you're using, power, electricity, and you haven't got the bill of power, electricity. Okay, fine. You are waiting for the electricity bill. It has not come. So maybe it will come after a month. So, but once you are closing the accounts, you have to make a provision. That means you have to pass an entry by debiting to power expenses and crediting to payable to the electricity board. So some entries are passed for which, either you have not received the bills, or for whatever reasons you are not able to pass those entries in the books of account because of the transactions have not really happened, or they have happened, but it is you have to make some provisions for adjustment entries to complete the books of account. Okay, fine. Like suppose you are having some, like let's understand from, a legal point of view, there would be a case which company is, fighting in the court. So company may decide that, they must take some kind of a provision that if they lose the case, then the company may lose some amount of money. So because, books are passed on the basis of a very conservative, basis, that's a, convention. So company may like to make a provision for any foreseen losses which may happen. Okay. So company may like to, fine tune the books of account by passing some entries on the last day of the financial year to complete the books, so that, it gives you a real picture about how much how much a company has earned profit. Suppose your company is making, say, 1 crore rupees of profit, but there is a case which is pending in the court, and if the company loses the court, the case, then, company has to pay some, say, 20 lakh rupees. Fine. So in fact, you have made 80 lakhs profit and not 1 crore. So you will make an entry in a books of account showing that, there is a possible, contingent liability that even if you lose the case in the next year, you have to pay that 20 lakh rupees because the case pertains to this year only when you're closing the account. So you have to make some provision with regard to any loss which may happen if you lose the case. So when you present your books of accounts or your financial statement to the shareholders, you can't say that I've made 1 crore rupees of profit. You will tell the shareholders that we have, profit made by the company is 80 lakhs, and because of there will be a note to the accounts saying that you have made a provision of 20 lakhs against some, case against the company, which there is a greater chance that you may lose it. So you are making a provision of 20 lakhs. So that's why you reduce your profit to 80 lakhs. So that will be a fair profit to show to your shareholders. Okay. So these are some adjustment entries you need to pass. It can be some bills like, electricity bill or telephone bill, which you haven't received. So you may like to, put them into accounts because these are the expenses you have already incurred, but you haven't got some bills. So for the want of bills, you can't just leave the books, without showing those expenses. So you have to make some provisions, some external entries. You have to pass them on the basis of some estimates. Okay, and these are called adjustment entries, right? And we'll discuss more about them later on. So, can you tell me what are adjustment entries? Anyone? ये क्या होती हैं? Adjusting entries in the books. Can you Google and find out?
सर आई बिलीव जब कोई गलत एंट्री हो जाती है तो फिर
हाँ,
उसको मतलब
हाँ,
तो मतलब ऐसा मतलब ऐसे मतलब उसे नोट करते कि मतलब जो क्रेडिट और डेबिट है वो मैच कर जाए।
हाँ. अगर गलती होगी है तो उसको भी सुधार सकते हैं by passing an entry. So that will be an adjusting entry.
हाँ,
Fine.
अगर कोई अमाउंट आपने कम लिख दिया फिर आपको याद आया कि ये अमाउंट तब लिखना था।
Yeah. So Mohit Yadav in accounting. Yeah, you have sent a message. Okay. So what is that? Let me read. In accounting, adjusting entries are journal entries usually made at the end of an accounting period to allocate income and expenditure, the period in which they are actually occurred. Yeah.
सर बेसिकली बात ये ना कि इट्स लाइक फॉर फॉर्मल लेटर दैट you're not allowed to cut anything or overwrite.
Yeah.
So that is why it is written here that in the end अगर आपसे गलती हो गई अगर पॉइंट ब्लॉक नंबर 5 में गलती हुई तो
Yeah.
you cannot override.
Sure, sure.
Come to
So,
the last block then.
yeah, absolutely. Point taken. So adjusting entries we'll understand more in detail as we will pass certain adjusting entries in our books of account. So there will be some examples which we'll be doing so that it will give you a better idea about that. Okay, fine. So whatever you have said, they are all right. Okay, fine. So then, finally you make the financial statement. So this is basically the end of everything. This is something which, everybody is looking for. The companies own, the management, the shareholders, the general public, the stock markets. So they want to know, what the company has done in the last year or last quarter or last month. So a balance sheet and an income statement can be prepared using the correct balances. Now, you will find all these balance sheet and income statements are available on the public domain, like we saw in this thing on a screener.in. All these 10-year balance sheets, profit loss accounts are posted by the companies in these sites, so that anybody can view. So company publishes these accounts for people to understand how the company is doing. Okay, so these are the financial statements. But this is not the last step. The last step is something called closing also. Okay, so which means that you have to close your account. Nika, can you read this? What is closing?
Yes, sir. The revenue and the expense accounts are closed and zeroed out for the next accounting cycle. This is because revenue and expense accounts are income statement accounts which show the company's performance for a specific time period. Balance sheet accounts are not closed because they show the company's financial position at a certain point in time.
Okay. Now, all the revenue accounts, which is basically all the expense and revenue which the company has made in that year. Okay. So ultimately, you just, show them in a profit loss account. And finally, you get, what profit the company, all the sales and revenue minus your expenses is your profit. Okay. Now, profit belongs to whom? The shareholders. Okay. So it will go to the reserve side, in the balance sheet. So the books of account will, when you start the next year books of account, all these expenses and income which you have incurred last year will not be transferred. Okay, only the profit or loss will go into the balance sheet. So this will show only the performance of the company. So next year, the new performance, it will start with a new slate. But the balance sheet accounts are not closed because the company which have bought assets and company which have paid to liabilities, they will be carried forward into the next books of account because they are either assets of the company or they are liabilities and they still exist. Okay, so the balance sheet accounts are not closed because they show the company's financial position. Like you have a building. Now you have to carry forward the building to the next year because the building still exists. So in the next year you will start your business that you have a building worth so many crores or so many lakhs. So the building or or inventory or your receivables or payables to your suppliers, all these balances will be taken to the next year. But all nominal accounts, which are basically the expense and revenue accounts, they will be left in the last year's book and they will be closed. So we'll be doing that. Okay, we'll be making an example to understand that also later on. Okay, further read, Mahika.
Final accounts. The process of accounting cycle ends with the preparation of final accounts. So let us begin various steps to compile final accounts.
Okay, now as we are understanding the closing of accounts, what happens is that because I've been in the accounts department working in many companies, so you find that maybe any of your anyone in your family who would be working in a finance department, they'll say आजकल closing चल रही है, or you go to the bank, they say कि अभी बैंक बंद है आज के दिन में, आज closing चल रही है. So closing means they're closing all the accounts and completing, to start fresh from the next day. So the closing for companies normally may take a week or 10 days or 20 days or months together. Okay, like in olden days when the books of accounts are all maintained manually. So we used to take almost like 5 to 6 months to close the accounts. Okay, and then the auditors would come and they would, certify the accounts and our financial statements. Nowadays, most of the companies close their accounts much faster, within a month or within 15 days. The big corporates, they publish their accounts by after 30 days or 60 days after they have been closed. So closing is a very important job. Then, we make these financial statements. So final accounts, okay? Fine. So we'll start with, as because final accounts can be for a company, for can be an individual businessman, okay, or for a charitable organization, non-profit organization. So everybody is supposed to write a books of account. Can be for a partnership concern also. So you have a sole proprietor, you have a partnership, business, you have a company business, you have societies, okay. So everybody is supposed to make books of accounts. So let's first understand the final accounts for a sole proprietor. So once you understand, then it becomes very easy to understand, books of accounts or final accounts for all kind of entities. So let's understand. So a sole proprietor, suppose there is a one person who is doing a business, fine. So he's called the sole proprietor. And then, it can be either a manufacturing organization or it can be a non-manufacturing organization. So if, a company is a manufacturing or it can be a non-factoring. A company means the company run by a sole proprietor. Okay. So he's an individual. Have you read about what are sole proprietors, what are partnerships, what are companies, what are societies? Have you done this course? I mean, somewhere in your.
No, sir. I guess it's in the Companies Act and we have
Yeah.
not started.
Yeah. So, actually, you can do business in various forms. Now, if an individual starts his business, it's called a business started by a sole proprietor, a single person doing a business. Okay. Then, if two or more people come together and do a business without forming a company, then we say it's a partnership firm. Okay. Then the two partners can decide, how much profit they are going to share. So normally, they may share 50-50% partnerships into their profits, or somebody can have 70%, other can have 30%. So that is called the partnership. Then the third can be a company. Instead of, you can register your company, you can incorporate it as a company. Now, companies can be also a private limited company or a limited company. Okay, so you have shareholders in that. So it is all governed by the Companies Act. So what Mohit you are saying is basically in Companies Act we'll talk about how the company, what are various provisions with regard to the accounts and final accounts in the Companies Act. Okay, fine. So and then lastly there can be a non-profit organizations like charitable institutions, societies, or any trust. So they are also supposed to get their accounts maintaining of their accounts as well as they get their accounts audited. Now in company also it is mandatory for most of the companies to get their accounts audited. So let's move back to the sole proprietor. Now a sole proprietor can be either a manufacturing business or it can be a non-manufacturing business. Okay, so both are supposed to make final accounts. Right. Now let's talk about the non-manufacturing. So he'll make three accounts: trading account, because since he's a non-manufacturing, so he's going to buy goods and sell goods. So he's doing a business of trading, and then a profit loss account. Okay, fine, and finally a balance sheet. Okay, whereas a manufacturing person will make final accounts, which we call the manufacturing account, trading account, profit loss account, and a balance sheet. Okay, so there is one more addition. In case of manufacturing concern, he is going to make a manufacturing accounts. Okay, so rest of the things remain the same. So let's talk about first a non-manufacturing organization. Okay, Mika, can you read?
Yes, sir. Non-manufacturing entities are the trading entities which are engaged in the purchase and sale of goods at profit without changing the form of the goods. In other words, non-manufacturing entities do not process the goods purchased and sell them in its original form. Meanwhile, it indulges in some liabilities, makes some assets, and also incurs some expenses like salary, stationery expenses, advertisement, rent, etc. to run the business. At the end of the accounting year, the entity must be interested in knowing the results of the business. To ascertain the final outcome of the business, that is, the income and financial position, they prepare financial statements at the end of the year.
So, like all these business entities, whether it's a sole proprietor or any other form, they basically make a financial statements. Okay. Now, these kind of organizations, they are non-manufacturing, so that means they're going to buy goods They're not going to process them and they're going to sell them. They buy in bulk and sell them in retail and make a profit, on that transaction. So, but they also incur, they have to indulge in some liabilities or they may buy some assets basically, and they may incur some expenses, advertisements in the newspapers, or they have to pay rent for the shop in which they are running the business or whatever. So they are incurring certain expenses. They are doing transactions, so they must get recorded. At the year end, they are interested to know how much profit they have made. So they have to make a profit loss account for that. So we'll understand that. So let's understand more. Okay, Mika, can you just read?
Financial statements are the systematically organized summary of all the ledger account heads presented in such a manner that it gives detailed information about the financial position and the performance of the enterprise. Performance of the enterprise is judged on the basis of the income earned accrued during the year in the form of profit after the adjustment of expenses related to the enterprise and to the income earned or accrued.
So basically, the financial statements, we all know it is basically in a transactions journal. You make a journal, then you enter them into a ledger, okay, which gives you a very detailed information about each and every account. And finally, you prepare your profit loss account after passing, all the entries and, transferring them to profit loss account and balance sheet. Any adjustment entries you need to make or any closing entries, so you need to pass them so that, you can make your income on the basis of the concept, accrual concept. Okay, so that is what it says. So in financial accounting, profit is measured at two levels. Okay, so there are two levels in case of a trader: a gross profit and a net profit. In fact, you will find this kind of a thing being repeated for all kinds of organizations, all kind of entities, whether it's a sole proprietor or a partner or a company. So whenever you're making your financial statements, they are at two levels. First, you calculate what is the gross profit. After you have calculated the gross profit, you arrive the net profit. So let's understand today what is gross profit. Okay, just read it.
The profit of the enterprise is obtained through the preparation of income statement. The financial position of the business enterprise is judged by measuring the assets, liabilities, and capital of the enterprise, and the same is communicated to the users of financial statements. Financial position of the enterprise can be known through the preparation of the position statement.
Okay, so we just straight away move to the trading account. Okay, so at the year end, or you can even prepare it on a monthly basis or a quarterly basis. So there's something called trading account, which a person who is doing a business, who is not processing the goods, they are buying the goods and selling them. Okay, they're buying in bulk and selling to retail and making some kind of a profit on that. Okay, so let's go to let's understand this through an example. Just read it.
Suppose in the first year, the net purchases are rupees 1 lakh and that rupees 15,000 worth of goods at cost were not sold at the end of the year. The cost of the goods sold will then be rupees 85,000.
Now assume that you are a trader, so you bought some goods. Okay, so your net purchase is 1 lakh. Why we are saying net? Because you may buy something and you may return also something. Okay, some goods may come to you, but you may not find them proper, so you can send it back to the supplier. So net purchases means what you have actually purchased them, net of anything which you have returned back to your supplier, which were not of a good quality or whatever. Okay, or you had not ordered and he has supplied you more, so you return them. So the net purchases you made was 1 lakh. Okay, but you found that 15,000 worth of goods at cost, which is still lying with you. So what is the cost of goods sold? 85,000. So that means you have sold 85,000 worth of goods. Okay, so you bought 1 lakh, you have a stock of 15,000. At the price at which you bought, it is worth 15,000. That is the cost. Okay, so that means how much goods you have sold? 85,000. So cost of goods sold. It's a very, very important concept. Cost of goods sold. So you must remember what is the cost of goods sold. It is basically the purchases minus the closing stock which you have. Okay, fine. Okay, read this.
If in the next year purchases are rupees 1,50,000 and the cost of goods on hand at the end of the year is rupees 20,000, the cost of the goods sold will be rupees 1,45,000 calculated as follows.
Now, can you just find out, without even going to the next slide, how this 1,45,000 has been arrived? Just apply your mind. I give you just a couple of minutes. How this figure of 1,45,000 has been arrived? Can you think of? By just intuitively applying what has been said in the first part of the slide. So how this figure 1,45,000 has been arrived? Just think of Mohit, Mika, or anyone. I mean, Dhruv, are you there?
So Drew is having some network issues. He texted
Acha.
me
Okay, okay.
like 10 minutes ago.
Okay. Ariman, just think about, I mean, anything.
Sir, can you present the slide again? Actually, I was
I'll do
not
that.
getting.
So I'm just saying, Abhay is there, Akshit. Okay, I'm just reading Arnav, Ariman, Aryan Jain, Ashutosh, Devansh, Devanshi, Dhruv, Katyani, okay, Mohit, Pratik, Prince, Rakshit. So please, Shrishti, all try. I mean, just try to find out. Just think about, how this figure has been arrived at 1,45,000. Okay. Just read the first statement, Mohit.
Suppose in the first year the net purchase are rupees 1 lakh and that rupees 15,000 worth of goods at cost were not sold at the end of the year. The cost of that goods sold will then be rupees 85,000.
So, what is the amount which has not been sold in that previous year? How much
Sir,
is the?
15,000.
Okay, so that means that will go to the next year, isn't it?
Yes,
That's
sir.
the stock. So
Yes, sir.
next year, what was your purchases?
Next year purchases was 1,50,000.
So that means you will have purchases plus the opening stock with you. So that will be available for the sale in the next year, isn't it?
So sir, 1,50,000 plus the 15,000 which were not sold.
Minus 20,000. So how much you get?
Just a second. Sir.
So I'm just opening up calculator also for you. So you had, 15,000 with you. Fine. Are you able to see the calculator?
Yes.
So this was the opening stock which you were having, and you bought another 1,50,000. Okay. The fresh purchases you made in the next year. Okay. Fine. And now you are left with another 20,000. Fine. The 20,000 is still with you. At the end of the year, 20,000 remains with you. Okay. So how much goods you have sold in the current year?
Sir,
So
1,45,000.
yeah, 1,45,000. Is that clear?
Yes, sir.
Okay. So now I'll just show that in the next statement. Okay. So cost of, just read this, Mika. Cost of goods sold from the top.
Cost of goods sold. Cost of unsold goods at the beginning of the year, 15,000. Purchases during the year, 1,50,000, 1,65,000. Less cost of unsold goods at the end of the year, 20,000. Cost of goods sold,
So
1,45,000.
in this year, how much goods have been sold? 1,45,000. So that is the cost, isn't it? For whatever you have sold in the current year is equal to 1,45,000. Now this 1,45,000, how we arrived? Because we had 15,000 at the beginning of the year, which was from the last year inventory. Now we purchased another 1,50,000 in the current year. So we had almost like 1,65,000 worth of goods with us. Okay. But at the end of the year, we still left with 20,000. So how much goods we have sold this year? One lakh. It's a simple mathematical calculation. Have you all followed? Meka, have you followed? Mohit, have you followed?
Yes, sir.
Yes, sir. Yes,
So
sir.
I think everybody has followed. Okay. So let's move. So now we will understand what is a trading account. So it become very easy. Okay. So now read this further.
If net sales, that is, after adjustment for sales returns, total rupees 2 lakh, the gross profit will be rupees 55,000. That is rupees 2 lakh minus 1,45,000.
So that means your sales minus your cost of goods sold. Your cost of goods sold is 1,45,000, and you have made a sales of 2 lakhs. So that means you have sold goods worth 1,45,000 at a price of 2 lakhs. So what is your gross profit? 55,000. Okay. And now you would like to know, what is the gross profit margin you have made. Okay. So you can just put up, I'll just put the, calculator again. So, so some people are interested in know what is my margin. Okay. So in that case, you say that I have made a profit of 55,000. Okay. Fine. And I'll divide this by 2 lakhs. And then multiply this by 100 to understand what percentage of profit you are making. So what is your percentage of profit on your sales? 27.5%, isn't it, Maika? Or everyone? Mohit. Is it okay?
Yes, sir.
Have you followed the calculation? Everyone? Have you followed how I have done the calculation? Should I repeat it again?
Yes, sir. Can you repeat it?
Okay, so this is very important. We can make two types of calculations. The first calculation which I'm making, please understand. So what is the profit? What is the gross profit of the company? Tell me. 55,000.
55,000.
So this is the gross profit of the company has made. And what
Yes.
is my turnover? What is my sales? 2 lakhs, isn't it?
2 lakhs.
So
Yes.
I can say that divide this by 2 lakhs. So gross profit divided by my turnover and multiplied by 100, I'll get the amount in percentage. So that means I am earning 27.5% on my sales. Is that okay? Now there is another way which we can calculate. We will take again the same 55,000. What is my cost of goods sold? 1,45,000. I can divide 1,45,000 also and arrive at what is my profit margin on my cost. Okay, and then I multiplied by 100. So then I say that I'm making almost like 38% profit on cost. Whatever is costing, I'm adding say 38% to it and arriving at my selling price. So either on selling price, I can say I'm making 27% profit, or I can say on cost, I'm making 37.93% profit. Okay. So normally you make a profit on your cost. So that means whenever you buy goods, suppose you're buying goods at 100 rupees and selling at 20 rupees. So you're selling at 120. So in that case, you say that I'm making a 20% margin. So that will be your 20 rupees profit divided by your cost, which is 100. Okay. So you say that I'm making a 20% profit on my goods, on my cost. Okay. इधर क्या हो गया? Into 100 था. So you're making 20%. Now let me just repeat it. Suppose you bought some goods at 100 rupees and you sold them at 150 rupees. So what is your profit margin on cost? Fifty divided by.
Sir,
Yeah.
Sir, you said 100 rupees was your cost.
Cost. And I'm selling the goods at 150. So what is my profit margin on cost?
Sir, 50 rupees.
So 50 rupees divided by the cost, that is 100. So what is my margin in terms of percentage?
Sir, half.
0.5.
50%. You can say simply 50%.
Yes, sir.
So you buy something at 100 and you add 50% to it. So it becomes 150 and you sell at that. Okay. Suppose one more simple question. Suppose you are buying a good at say 100 rupees and selling at 15 rupees, at 115 rupees. So what is your profit margin on your cost?
Sir, 15%.
Absolutely. Okay. So now one more question, final question, and anybody else should reply. And I mean, suppose you are buying goods at say 80 rupees and you're selling at say 100 rupees. So what is your profit margin on cost? Just calculate.
So 20%.
No.
Sir, buying at
Buying at 80, selling at 100.
So 80%?
Sir, 20 divided by 80.
So 25%.
25%. Okay.
25%.
Mika, you are buying at 80 and you are selling at 100. So what is your profit? 20. What is your cost? Divided by 80. Okay. And multiplied by 100. 25%. Is that okay? One more final question so that it settles in your mind. Suppose you are buying some goods at say 80 rupees and you're buying goods at 75 rupees and selling at 100. So what should be your profit margin? Your cost is 75, you're selling at 100. Yeah.
Sir, 25.
No.
Sir, 33.3. 33.33.
Yeah. So you're selling at 100 and buying at 75. So divide by 75.
Oh, yes.
So your profit margin is 33%. Isn't it? When you do business, you always buy at certain price and you put up a markup and say this is going to be my profit and you're going to sell. So you want to know how much percentage of profit you're making. So finally, one more. So you are buying at 60 rupees and you're selling at 100 rupees. So what should be your profit? In terms of percentage, please let me know. Use your calculators. You're buying at 60 and selling at 100.
Is it 40%? 0.66.
So you're selling at your profit margin is 40. Yeah. What was this thing? What is the answer you said?
60%, sir.
66.6.
66.66%.
Yes, sir.
Okay, so this is, sorry, it is like, your profit is 40, okay, on a cost of 60. So you 40 divided by 60, okay, and then you multiply it by 100 to calculate your margin. So your profit margin is 66.6. Have you got, all of you? Someone may add,
Yes, sir.
mathematics में सब poor हो. Anyway, you're lawyers, you're not, accountants, or you're not people who are good at maths. ठीक है, चलो, don't worry. It comes, by practice only. So let's go further, okay? Okay, read the last sentence. Meika, are you there?
The profit is called gross profit since from it expenses have to still be deducted for knowing the net profit.
So basically, the first step is to arrive at the gross profit. Okay. Now, the gross profit is very, very important. Okay. I'll just tell you that later on, why it becomes very important for so many people. And then once you have arrived at the gross profit, then the company is supposed to know their profit. Okay. That's called the net profit. Ultimately, the net profit is the money which the company is earning finally. So all the expenses which have been incurred thereafter making the gross profit will be shown in the profit loss account, and you will arrive at the net profit of the company. Now, the gross profit is very important because it tells you, how much gross profit you're earning. Suppose, you are a business owner and you are saying that I'm going to charge, say, 30% on my cost, okay, and I'm going to sell my goods. Now, since you are doing so many businesses, your accountant brings a statement and tells you that you have made only 25% profit on cost. So there's some problem. Either the books have not been properly written, or there is some kind of an error, because you know that you're buying goods and you're making 30% profit on your cost, because you have given those directions to the people that the markup is going to be, say, 30% or 25%, whatever. So you should get 30% as your gross profit if you calculate how much percentage you're getting. But if you look at the trading account and gross profit, and you find that the profit is coming to be less than 30%, there would be some error, fine. So it gives you basically a picture and tells you whether your books of accounts have been properly written or not. Maybe that, some entry has been missed, okay? If the gross profit is coming less, okay, so that means some sale entry has been omitted to be passed. So that's why you're getting a lower profit in terms of percentage. So we'll discuss that a little later. And then, one more thing, I remember about, 20 years back, I had a company. I was working with a company called Balarpur Industry, which was, the 20th largest company in turnover at that time in India. So I was working in a very small unit in Faridabad of that company, having a very small turnover. But, we went to the income tax office and our income tax assessments were happening. So the income tax officer or the commissioner of income tax who was handling our case, so he compared the gross profit margin compared to this year, compared to the last year. And he found that there was a big change. So he asked us to, explain what was the reason why the gross profit has come down from say 30% to 25%. Okay. I don't remember exactly the numbers. So we had to explain everything to the ITO, to the commissioner. If a proper explanation are not offered to the tax officers, so they may say that your accounts are wrong, since you have no reason, your sale price is same, your costs are same, so you can't have a different gross profit in this year. So that means you have indulged in some malpractice. So he's going to levy a demand on you. So he's going to, increase your income and ask you to pay taxes. So this gross profit is a very, very important. It is normally seen by all the tax, people who are, assessing your profits, and ultimately you are supposed to pay taxes. And the assessments, they are seen very, detailed manner by the taxing authorities, that why the gross profit margins have gone down, despite you don't have a reason to explain. If you have reason to explain that you are buying now goods costlier, or you reduce your margins, or whatever the reasons, you have to present those reasons to the tax authorities to prove your point. Otherwise, they are going to levy demand on you. Okay. Now, okay. So this is, this is called the trading account. Okay. So look at the format of the trading account. The opening inventory was 15,000. Purchases were 1,50,000. This is coming from the last example. Sales was, 2 lakhs. So your gross profit is 55,000. So this is the way you make your trading account. Okay. In a T-shaped format, where you will have a debit side and a credit side. And debit side, the opening inventory will come, purchases will come. On the credit side, you will have sales and the closing inventory, and ultimately gross profit will be calculated, and which will be carried forward to your profit loss account because you are incurring some more expenses thereafter, okay, to find your net profit. So today we are just going to focus on that. So look at this question, okay. So can you read, Mohit, the question?
Yes, sir. From the following information, prepare a trading account of Miss ABC, trader for the year
Not
ended
Miss, it is Messrs ABC, okay, fine.
Oh,
ये
Messrs
मिस, हाँ, ये
ABC.
मिस एबीसी नहीं है, they are called Messrs ABC, okay, fine, just read.
Okay, sir. Messrs ABC traders for the year ended 31st March 2021. Opening inventory of 1 lakh, purchases 6,72,000, carriage inwards 30,000, wages 50,000, sales 11 lakh, and return inward 1 lakh, returned outward 72,000, closing inventory 2 lakh.
So basically, this is a very simple question where we says that this is accounts. You have to prepare a trading account out of the information which has been given to you. So you had an opening stock or inventory of 1 lakh. So you made purchases during the year 6,72,000. Then you incurred some expenses for bringing the goods. When you make purchases, you have to incur some expenses for bringing the goods to your place where you are doing business in form of transport charges or whatever. So it's called carriage inwards. So carriage inwards are related to your purchases. Then you have paid some wages. So you're having some people who are helping you for doing your business in your so you are paying them wages. So normally wages are paid to basically the people who are not like qualified people, but they are not qualified people, so they are just helping you. They're helpers, basically assistants, so you pay them wages. Then sales, so this is basically the amount of goods you have sold. Then return inwards, which means that you sold 11 lakhs, but 1 lakh goods were returned by your customers. Okay, so return inwards are basically related to your sales, how much of goods you have received back. Return outwards would be basically out of your purchases. That means whatever you have returned, return inward will be coming from your customers, and return outward will be whatever you have purchased and you have sent it back to your supplier because you didn't find the goods to be good. You're not going to sell them, so you just return them back. Okay, and then finally the closing inventory, which is 2 lakhs. So now you're supposed to prepare a trading account. So just open an Excel sheet which I have sent you in your in a WhatsApp. Okay, just open your WhatsApp and there is a statement which I have shared with you. Okay, do you find any statement today?
Yes, sir. It's a
It's called trading
account.
account. Okay, just open up that.
Yes, sir.
So this is the same thing. Okay, just are you able to see that trading account on your? I'm sharing.
Yes, sir. It's visible.
Visible. So the first statement is particulars, the same particulars which I presented. So then we go to the trading account. Okay. So second statement is trading account. Okay. So what we do is, first of all, we put the opening inventory. Okay. So what I do, I just put a plus sign, go to my, this thing, opening inventory. So this will come on the debit side. Then purchases. Okay. So since it has purchases and returns also, so I'll put purchases here. Okay. Go to my purchases, 6,72,000, and then the returns. So I'll just go and see if I have returned something. Yeah, I have returned 72,000. So I'll put it here, and this is basically the final number, which is basically this minus this. So you can also do it along with me. Okay. So can you do? I mean, everyone. So just open this. Should I start again?
Yes, sir,
Yes,
please.
sir.
I just lost my connection.
Okay.
Sorry.
So what you can do is basically you can just delete, clear all the contents. First, clear all the contents, become a blank sheet. Is it?
Yes, sir.
Has it become clean for everyone?
Yes, sir.
So now on the amount side, put your cursor here, okay, and put a plus sign here, and go to the information which has been provided, which is opening inventory, and enter. Have you got this opening inventory 1 lakh on your listing on your?
Yes, sir.
Then
Yes, sir.
on the internal column, the first column, go to your purchases and go to the particulars and pick up their purchases. Okay, fine. So purchases picked. Have you done it all? Have you got purchases?
Yes,
Yes,
sir.
sir.
Okay. Then less return outwards. That means whatever you purchase, you have returned some goods back to your suppliers. You don't need it. Okay. So it is given right at the bottom before the closing inventory and put it here. Okay. Have you got it?
Yes, sir.
Now put a cursor here where I'm put just next to 72,000. Add this and minus this and enter. So your purchases are now, you bought goods worth 6,72,000. 72,000 you have returned. So what is your final expense for the year? 6 lakhs.
6 lakhs.
Okay. Then go to carriage inwards. This is your expenses which you have incurred. Basically, perhaps transporting the purchases or goods into your factory or in your business. Okay. So you go to carriage inwards and pick up it. The carriage inward is your expense which you have incurred for paying, some transport charges on whatever goods you have purchased. Assuming that. Okay. So put it here. Done.
Yes, sir.
Yes, sir.
Then go to wages and put a plus sign here. Go to wages and pick it from here, wages. Have you done?
Yes, sir.
And then go on the, the credit side, okay, and put sales. Actually, this I have not written. So put sales, okay, and go put your cursor on the internal side because the sales have some returns. So go to your sales, okay, sales 11 lakhs. Fine. And then you have some return inwards, okay, return outwards, okay, return inward. हाँ, आपके पास वापस सामान आया है बाहर से. So put a return inwards here, either by putting a cell referencing, or you can just put returns inward, okay. Either type the word or take it from the particular site and put the amount here. What is my return inwards? So that means I have sold some goods, but the customers have returned back to me. Okay, have you got it?
Yes, sir.
And then take your cursor outside and put your cursor outside, put it on 11 minus 1 lakh. So your net sale is now 10 lakhs. Have you got it?
Yes, sir.
Then just go to this line and put a cursor here and bring the closing inventory here. So the closing inventory, that means how much stock you are still having, okay, and put the amount of closing inventory next to it by putting this amount, 2 lakhs. Have you got it?
Yes, sir.
And then finally just place your cursor at the end, last column, and just add this 2 lakhs with your 10 lakhs. So this is basically your total, okay. So I'll just put the column here as total on both sides, okay. Fine. So that's the total, okay. Now put a cursor here on the gross profit, okay, and put a plus sign here and take this 12 lakhs minus this, minus this, minus this, minus this, and enter. So your gross profit is how much? 4,20,000. Now simply add them up. So you'll have 12 lakhs on both sides. So how much profit the company has made? 4,20,000. Okay. Just have a look on the trading account now. See, this was your sale, 10 lakhs. After the customers have returned everything, you sold them 11 lakhs, but they returned 1 lakh. So your sale is 10 lakhs. You have inventory with you, okay, which is 2 lakhs. Now, you started the business with 1 lakh inventory. You purchased, goods worth 6,72,000. Some goods were, returned by you. So that means your total purchases, net purchases, 6 lakhs. Okay, fine. Then you incurred some expenses, which is like carriage inwards or wages. Okay, so your cost of goods sold will be basically, we have arrived at, and then you found that what is my gross profit. Okay, which is your, sales, opening stock plus sales, minus closing inventory and minus these two expenses, you get your closing profit, gross profit. Okay. So, do you understand how we have arrived at the gross profit? This is basically all your credit side and all your debit side. You just arrive the balancing number here, which is 4,20,000, which is your profit of the company. And now you want to know what is my gross profit margin. So you put this number and go to, you're basically on, if you want to arrive at sales, then you can arrive at sales, which is 42%, and make it 42%. You can make it as a percentage here also. Okay, so your gross profit is 42% on your sales, but you can even arrive at or your cost also. Okay, so for doing that, what you can do is put your cursor here and 4,20,000. So in that case, basically you have to make a total of this also. Okay, this is a bit complicated here. So just total or total, and this comes to 7,80,000. So your gross profit margin on cost will be this divided by this, which you can make the total of this also. Okay, so you can just put it there, and this also you can make here. So this is your gross profit on cost. This is the cost profit on sales. So cost is better. Okay, so you can just shift this also there.
So can you please explain the last step again?
I'll do that. So this I can, just, okay, fine. So I'll just explain again, okay? How I have arrived at 54% or what? Have you followed the gross profit?
Yes, sir.
Okay.
I follow.
So you want to know what is my gross profit percentage? Okay. So I put my cursor here. What is my gross profit? 4,20,000. What is my cost? 7,80,000.
780.
Okay. Enter it. 54%. My gross profit is 4,20,000. My cost is, and I can say my cost here is 7,80,000. Okay. And my gross profit is 54% altogether on my cost. Now, have you got it?
Yes, sir.
Okay. So now we are, having a break. So what you can do, you can just go through this Excel sheet again, and at the end you have to do this exercise yourself. Okay. So there is a fresh question which is there in the next slide. So calculate the gross profit as well as calculate the gross profit margin. Okay. So this is what you're